By the end of this video, you will know exactly how to build a simple, powerful investment portfolio using just one fund, and you will have the confidence to stop second-guessing yourself and start growing real wealth today. I am about to show you why Warren Buffett, the greatest investor of all time, has publicly instructed that 90% of his wife's inheritance go into a single S&P 500 index fund, not hedge funds, not private equity, not a team of expensive advisors, one index fund. And here is a number that should stop you in your tracks. Over the past 40 years, the S&P 500 has turned a single $10,000 investment into over $700,000. That is not a typo. $700,000 from doing almost nothing. But before we get to the one strategy that most financial advisors will never tell their clients, a strategy that could shave years off your wealth-building journey and save you tens of thousands in fees, let me tell you exactly what you are going to learn in the next 15 minutes. First, I am going to show you exactly what the S&P 500 is and why it has crushed almost every other investment vehicle for the past century. Second, you will learn the 3 critical mistakes that cost the average investor over $170,000 over their lifetime. And third, I am going to give you a step-by-step action plan you can execute before this video ends. Quick, if you have ever felt overwhelmed by investing, confused by all the conflicting advice, or worried that you are falling behind financially, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need this information. Let me paint a picture for you. You open your investment app. You see thousands of stocks, hundreds of funds, endless opinions from so-called experts on television. One guru says buy tech stocks. Another says gold is about to explode. Your coworker brags about his cryptocurrency gains while your brother-in-law swears by dividend stocks. You have 17 browser tabs open. Your watch list has 43 random tickers you barely remember adding. And at the end of the day, you do nothing. Your money sits in a savings account earning 1.5% while inflation eats away at it like termites. This is not just overwhelming, it is expensive. Studies show that the average investor underperforms the market by 4.3% annually, not because they pick bad stocks, but because they pick too many stocks, trade too often, panic at the wrong times, and pay too much in fees. Let me put that in real terms. A 4.3% annual underperformance on a $500 monthly investment over 30 years costs you $173,000. That is not monopoly money. That is your retirement. That is your kids' college fund. That is the vacation home you dreamed about. Gone. Because of complexity, because of confusion, because of a system designed to make you feel like you need to do more. But here is what nobody tells you. The solution is not more information, it is less. The solution is not more funds, it is one. And that one fund might just be the only investment you ever need. So what exactly is the S&P 500? The S&P 500 is an index that tracks the 500 largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Google, Johnson & Johnson, J.P. Morgan Chase. When you buy an S&P 500 index fund, you are buying a tiny piece of all 500 of these companies in a single transaction. You become a part owner of the American economy. Here is a scenario that makes this real. Let us say your neighbor tells you about an incredible company that is going to change the world. You invest $5,000. It goes bankrupt. You lose everything. But if that same company was in the S&P 500 and you owned an index fund, that bankruptcy would barely register. Why? Because it represents maybe 0.2% of your total holdings. The other 499 companies keep chugging along. This is called diversification, and it is your single greatest protection against catastrophic loss. Here is where most people get this wrong. They think they need to pick the next Amazon, the next Tesla, but studies show that 90% of individual stock pickers underperform a simple index fund over 20 years. The fix is simple. Stop trying to find the needle in the haystack, just buy the entire haystack. And here is the beautiful part. When new companies rise to dominance and old ones fade, the index automatically adjusts. You never have to make a decision. Stop. Before I continue, this next part is critical. Understanding why index funds beat active management is the key to keeping your money where it belongs, which is in your pocket. Every year, a research firm called Spiva publishes a report comparing actively managed funds to the S&P 500. The results are brutal. Over a 15-year period, 92% of large-cap fund managers failed to beat the index. 92%. These are professionals with Ivy League degrees, billion-dollar research budgets, and teams of analysts working around the clock. And they still lost to a fund that a teenager could buy on their phone in 30 seconds. Let me give you a concrete example. The average actively managed fund charges an expense ratio of around 0.7% annually. The Vanguard S&P 500 Index Fund charges 0.03%. On a $500,000 portfolio, that is a difference of $3,350 every single year going to a fund manager who statistically will underperform anyway. Over 30 years with compounding, that fee difference alone costs you over $200,000. Here is the mistake most people make. They assume higher fees mean better performance. They see a fund with a fancy name and a well-dressed manager on television and think, this must be worth it. It is not. The actionable fix is this. Before buying any fund, check the expense ratio. If it is above 0.2%, you better have an incredibly compelling reason. Your future self will thank you. The power of compound interest inside an S&P 500 index fund is almost unfair once you understand the math. Let me show you something that changed my entire perspective on investing. If you invest $500 per month starting at age 25 and earn the historical S&P 500 average return of roughly 10% annually, by age 65 you will have over $2.6 million. You contributed $240,000. The market gave you $2.4 million in gains. But here is the kicker. If you wait until age 35 to start, you end up with just under $1 million. Same monthly investment, same return. 10 years of procrastination cost you $1.6 million. This is not about being rich already. This is about time. Your 20s and 30s are not the time to figure it out later. They are the time to start, even if it is just $50 a month. The mistake 80% of people make is waiting until they feel financially comfortable to invest. But comfort comes from action, not from waiting. Start with whatever you have. Increase it by 1% of your income every 6 months. You will barely notice the difference in your paycheck, but you will absolutely notice it in your portfolio. I need to pause here because this is where most people go wrong. They hear about the S&P 500, they get excited, and then they do something that sabotages everything. They try to time the market. They see a headline about a recession coming and they sell. They wait for a pullback that never comes. They freeze. Let me share a study that should be framed on your wall. Bank of America analyzed data from 1930 to 2020. If you miss the 10 best trading days in each decade by trying to time the market, your returns dropped from 17,715% to just 28% over that 90-year period. Missing just 10 days per decade destroyed almost all of your gains. The best day in the market often comes right after the worst day. You cannot predict it. Nobody can. The fix is brutally simple. Automate your investments. Set up automatic transfers from your bank account to your brokerage on the same day every month. Take emotion out of the equation entirely. The S&P 500 has recovered from every single crash in history. The Great Depression, the dot-com bubble, 2008, the pandemic. Every single time. Your job is to stay invested. If you have made it this far, you are already ahead of 95% of people. And what I am about to share in this next section is the most valuable part of this entire video. Do not skip it. Subscribe to Wealth Decode Plus if you have not already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Now, let me address the elephant in the room. Is the S&P 500 truly the only investment you need? This next section changed everything for me when I first understood it. The honest answer is that for most people, in most situations, yes. A total market S&P 500 index fund provides everything you need for long-term wealth building. But there are nuances. If you are under 40, many would argue you should be 100% in stocks, and an S&P 500 fund accomplishes that beautifully. If you are over 50 and approaching retirement, adding some bonds for stability makes sense, perhaps through a target date fund that automatically adjusts. Here is where most people overcomplicate things. They add international funds, sector funds, real estate funds, emerging market funds, and suddenly they have 15 holdings that they do not understand and cannot explain. Studies show that the S&P 500 is already globally diversified because companies like Apple generate over 60% of their revenue internationally. You are getting global exposure through American companies without the added complexity. The actionable insight is this: simplicity is a feature, not a bug. One fund eliminates decision fatigue, reduces fees, removes the temptation to tinker, and historically outperforms complex portfolios. But here is what nobody tells you about dividends, and this matters more than you think. The S&P 500 does not just grow in value, it pays you. Every quarter, companies in the index distribute a portion of their profits to shareholders. The current dividend yield hovers around 1.4%. That might sound small, but let me show you the real numbers. On a $500,000 portfolio, that is $7,000 per year in passive income. If you reinvest those dividends, which happens automatically in most funds, they buy more shares, which generate more dividends, which buy more shares. This is the snowball effect that separates the wealthy from everyone else. A study by Hartford Funds found that from 1960 to 2022, 84% of the S&P 500's total return came from reinvested dividends. Let that sink in. The growth you see in headlines is only 16% of the real story. The mistake people make is focusing only on price appreciation while ignoring the quiet engine of dividend reinvestment working behind the scenes. Make sure dividend reinvestment is turned on in your brokerage account. This one setting could be worth hundreds of thousands of dollars over your lifetime. Let me talk about which specific fund to actually buy because I know you want concrete answers. You have three main options. First, the Vanguard S&P 500 ETF, ticker symbol VOO, with an expense ratio of 0.03%. Second, the iShares Core S&P 500 ETF, ticker symbol IVV, also at 0.03%. Third, the SPDR S&P 500 ETF, ticker symbol SPY, at 0.09%. All three track the same index. All three will give you nearly identical returns. The differences are negligible for most investors. VOO and IVV are marginally cheaper. SPY has slightly higher trading volume if you trade frequently, which you should not be doing anyway. Here is the mistake most people make. They spend weeks researching which one is better. This is procrastination disguised as due diligence. The best fund is the one you actually buy, the one you fund consistently, the one you hold for decades. Pick one today. Open a brokerage account with Fidelity, Vanguard, or Charles Schwab. Buy the fund. Set up automatic monthly investments. Move on with your life. The difference between these funds over 30 years is probably a few $100s. The difference between starting today and starting next year could be $50,000. Now here is your practical action plan, and I want you to do this before the day ends. Today, in the next 10 minutes, open a brokerage account if you do not have one. Fidelity, Vanguard, and Schwab all offer free accounts with no minimums. Download the app. Enter your information. It takes 8 minutes. This week, decide on your monthly investment amount. Calculate 1% of your monthly income. That is your starting point. If you make $4,000 per month, start with $40. Set up an automatic transfer from your checking account to your brokerage account for the first of every month. Then buy your first shares of VOO, IVV, or SPI. If you can only afford one share, buy one share. This month, increase your contribution by $25. Review your budget and find one subscription you do not use, one expense you do not need. Redirect that money to your S&P 500 fund. Turn on dividend reinvestment in your account settings. Use free tools like Personal Capital or the Vanguard Portfolio Tracker to watch your progress. Then do absolutely nothing else. No checking daily, no reading headlines. Invest and forget. That is the system. Remember at the beginning when I mentioned the one strategy most financial advisors never tell their clients? The strategy that could shave years off your wealth-building journey? Here it is. The secret is that there is no secret. The strategy is simply buying a low-cost S&P 500 index fund, funding it consistently, and leaving it alone for decades. Financial advisors often do not tell you this because it threatens their business model. They cannot charge 2% annually to manage your money if you realize a free app and 10 minutes of setup accomplishes more than they ever could. Wall Street has spent billions convincing you that investing is complicated, that you need experts, that you cannot do it alone. That is a lie designed to extract fees from your pocket. You now know the truth. Let me give you your 3 key takeaways. 1. The S&P 500 has outperformed 92% of professional fund managers over 15 years. 2. The difference between starting today and waiting 5 years could cost you over $300,000 in lost gains. 3. A single low-cost index fund provides all the diversification, growth, and income you need to build life-changing wealth. Comment below and tell me which strategy you are going to implement first. Is it opening your brokerage account today, setting up automatic investments, or finally turning on dividend reinvestment? I read every single comment and I will personally reply to as many as I can. In tomorrow's video, I am revealing the exact step-by-step process to protect your investments from taxes, something that took me years to figure out and most people never learn. Subscribe right now so you do not miss it.